Hello friends, welcome back. Now what I'm going to do is right now, I'm going to take up two very specific examples from the market and let people do an actual calculation of the duration for each of these bonds and see which one makes sense for investments in different interest rate scenarios. All right. All right. So we wanted to discuss how the present value of bonds are calculated, and we also wanted to understand how the concept of duration kicks in when we are looking at bond mathematics. All right, so let's get going. So we will look at three very important things: how to calculate the price of a bond. All right, so we will look at how to calculate the price of a bond. We would look at how to calculate the Macaulay duration of a bond. All right, and then we are also going to look at how to look at modified duration of a bond. Okay, duration of a bond. All right, so these are the three things that we're going to look at. Okay, let's get started. So let's look at today as an issue date for a bond. This bond matures in 3 years' time. All right, it pays a coupon of 7%. All right, and let's calculate the price of the bond. So since it is a 7% annual coupon, so let's make it annual coupon paying bond. So in 1 year's time, that is on 4th November 2025, we will receive 7 rupees. Okay, we will receive 7 rupees on 4th of November 2025. We will receive 7 rupees on 4th of November 2026, and the bond matures on 4th of November 2027. That is 100 plus 7 rupees, 107 rupees. All right, so this is how the cash flows. So first and foremost is to organize the cash flows. Okay, so this is a very important step. We will look at organizing the cash flows of the bond. Okay, perfect. Now, as a next step, in order to calculate the price of a bond, we need to calculate the present value. We need to calculate the present value. Okay, PV or present value. So how do we go about calculating the present value? Okay, so what does this mean? The future value. So this 7 rupees is received 1 year later. This 7 rupees is received 2 years later, and this 107 rupees is received 3 years later. So what is the present value of this 7 rupees as of today? What is today? Today is 4th of November 2024. Okay. Now, so how do we calculate that? So it's a simple formula, which is the future value E7. E7 is the future value divided by 1 plus the yield. All right. The yield is 7%. So let over here we have taken yield as 7%. That means while the coupon is 7, I am buying this bond at 100. That means the yield is 7. So the future value whole divided by 1 plus e to the power time period. So it is coming to me in 1 year's time. All right. So please all of you do this. You should get a figure of number of 6.5421. Okay, up to 4 decimal points. 6.5421. What it means, 7 rupees received 1 year later is equivalent to 6 rupees 54.21 paisa as of today. Similarly, calculating the present value of the 7 rupees receiving 2 years later, now to the power again c to the power 8, which is over here right now, to the power becomes 2 because I'm receiving it 2 years later. Okay, so the present value of 7 rupees being received 2 years later is 6.1141, and the present value of 107 rupees received 3 years later is 87.3439. Okay, now how do I calculate the price of the bond? The price of the bond is nothing but a summation of all the present values of all the future cash flows. Okay, we calculate the present value, and then as a third step, let me just remove these things. Okay, 1 second. Let me just insert a few rows so we know exactly what we are looking at. Okay, this is present value. Then we will add up the present value, sum up all the present values of the future cash flows. Okay, so this is what we do as a third step. This equals to the price. Okay, this is equal to the price. So summation of all the present values of the future cash flows is 100. Okay. Now let us understand. We always discussed that price and yield are inversely related. That means what? If the yield goes down, let's assume the yield goes down from 7 to let's say 6, the price should go up. So let's check that, and the price jumps to 102.67. Okay, correct. As the present value becomes higher, the present value becomes higher. Okay, if the yield keeps moving lower, the present value keeps going higher and higher and higher. Okay, it keeps going higher and higher. So that means if I'm looking to invest in a bond in a scenario when yields are declining, I'm interested in my price, right? This is the price. This is the price. So I will keep investing in a bond in a declining interest rate scenario. Okay, and obviously I will keep making some gains. All right, keep making some gains. Let's look at what's the alternative. Now instead of 7, let's come back to 7. And suppose the yield goes to 8%. The price of the bond becomes negative from a perspective of the par value. So it started trading at a discount. Okay, if the yield keeps going higher, 9%, the price keeps falling. Okay, if the yield keeps going higher, the price keeps falling. So what it shows is that generally in bonds, there are two parts to the total investment. Okay, one is the coupon that I'm receiving, and second is the price movement. So the fourth thing to remember is in the bond is we need to know which direction the yields are headed is important. Okay, that's a very important thing to know. And the fifth thing to know is what will be the total return. What will be the total return? Total return will be a combination. It's a summation, not a combination. Summation of the coupon plus the price change. Okay, these are the few very important things. So that as the yield keeps moving up, the price keeps moving down. Okay, price and yield are inversely related. All right, now let's look at one step further. Let's look at the concept of duration. Okay, let's look at the concept of duration. So how do I calculate? Let's not look at modified duration now. Let's look at Macaulay duration first. What is Macaulay duration? So this part we have understood. All right, so let's look at Macaulay. So what does Macaulay say? Macaulay says we know the present value. Okay, look at F7, we know the present value. With the present value multiplied by the time period. ये present value by when is it coming back? कब तक मेरे पास वापस आ रहा है? So 6.5421 is coming back in 1 year's time. This 6.1141 is a present value which is 2 years time, and this. So you multiply by that. Okay, so the weightages are the time periods. This multiplied by 1, this multiplied by 2, this number multiplied by 3. Okay, multiplication, and then divided by the price. Okay, which is the F10, which is the price. Okay, you sum up all these three numbers, you get something which is called the Macaulay duration. Macaulay duration. Okay, Macaulay duration. All right. So Macaulay duration is the weighted average time period. Okay, weighted average time period. Weighted average time period to receive the initial investment. Okay, initial investment. Very important. Kab tak ye paisa? So it's a 3-year bond. So the entire money comes back to me in 2.808 years. Okay, 2.808 years. Now let us look at the concept of modified duration. Okay, what is modified duration? Modified duration is this Macaulay duration. Modified duration, all right, modified duration is this Macaulay duration, which is this G11, okay, whole divided by 1 plus yield, which is 7. 1 plus yield, you get modified duration. Okay, modified duration. Macaulay duration divided by 1 plus yield. Macaulay duration divided by 1 plus yield. Okay, so that is modified duration. Modified duration is the interest rate sensitivity. What does it mean? It means that if interest rates, so let's look at this and what it means is that if interest rates come down by 1%, prices go up by 2.624%. Okay, let's look at it whether it actually happens. So let's say when the yield is 7%, price is 100. Okay, let me write it down. Then when let's say the yield becomes 6, the price becomes, yield becomes 6, the price becomes 102.673. Okay, 102.673. What did it say? It said that it should have been 102.652. It should have been 102.652. There is a gap. How much is the gap? This is the gap. This gap is called convexity. This gap is arising because of convexity. So we will look into this concept of convexity later, but we should know that while it says that modified, but it's pretty close, very, very close approximation about what would be the change in the price of a bond for a unitary change in yield. So instead of 7, let's assume that yield becomes 8. Yield becomes 8. Okay, if the yield becomes 8%, what is the price? 97.4229 and 2.59 Girinatha. So this plus 2.598, it's pretty much close. Okay, 100, right? So modified duration helps in calculating the potential change in price that could happen because of a unit change in yield. All right, super. Now let's get back to the main video. Thank you. Now that we have seen how the actual duration of two specific securities change with difference in yields and so on. So what are the few things that we learn? We learn as an investor, we definitely have to look at duration. Okay, and which duration out of the two durations? The modified duration. The modified duration. Modified duration helps us identify the interest rate sensitivity. Okay, now let me ask you a question, and all of you please go through this question and you can respond in the comment box later. Is that, let me give you two options. Okay, now in India, let's say the 10-year G-Sec is trading at 7.21. Okay, so today the 10-year G-Sec is trading at 21, and so this is an actual data, and the question is, if we expect, so this is the 10-year, so let me make it little interesting. This is some one bond, and the second bond is that a 15-year G-Sec, 15-year G-Sec is trading at, let's say, 8%. This is ad hoc data. Okay, 10-year G-Sec is trading at 7.21, 15-year G-Sec is trading at 8%. Now we have two scenarios. Scenario 1, we are expecting a repo rate cut. Okay, so which one would you select? Would you select A or B is the question. So all of you think about it. Like there are two bonds in front of you. One is a 10-year trading at 7.21. The second is a 15-year trading at 8%. And you are expecting a repo rate cut. Which one would you select? So that's question 1. Second scenario, we are expecting a repo rate hike in order to control inflation. In order to control inflation, maybe in the next 1 or 2 months. Maybe not immediately, but in the next 1 or 2 months. And you have definitely a 1-2 year kind of investment horizon. Which one would you select? A or B? All of you are requested to write your answers with the reasoning in the chat box, or sorry, in the comment box, and we would definitely come back and respond to each of your questions. We look forward to your inquiries, your questions further on this subject, because we do understand duration is a concept that actually keeps investors away from the world of fixed income. The sooner we learn how this risk is calculated, the faster we would be able to mitigate this risk in the world of fixed income and create a very beautiful, smooth, balanced portfolio which will last all kinds of market cycles. And thereafter, after we understand this concept of duration, we will move into the world of convexity. Okay, but we will move into the world of convexity little later. But before we talk about that, let me show you some different thing. Okay, right. So this is price chart. This is yield. So what happens as the yield goes lower? Sorry, price yield. Okay, as the yield goes lower, price is higher. So that if the yield comes down, price is here. Let's say this is the point. As the yield goes up, price comes down, because price is inversely proportional to yield. Correct? Price is inversely proportional to yield. Now let's assume this is 0, 0. Okay, and this is, let's say, 7, 8, 9, 10, 11. Okay, and this is, let's say, 7% bearing bond. At 7%, this price is 100. This is 99, 98, 97, 96, and so on. So, and if I connect all these crosses, I get a curve, and this curve is called the yield curve. All right, so this curve is called the yield curve. We will discuss more about this yield curve later once again, but this is a very important concept that we should all try and understand a little more as we understand the world of fixed income, because whenever yields change, it can become 6, 5, and all of that as well. So it will become so this is the par value. It can become premium also. So right now the bond is trading at a discount. It can trade in a premium depending upon which side of the coupon it is. As if the current YTM is equal to coupon, then the price is equal to 100. Okay, if the YTM is more than the coupon, then the price is less than 100. That means it's trading at a discount. And if the YTM is more than the coupon, then the price is trading at a premium. If YTM is more than the coupon, if the YTM is less than the coupon, then the price is trading at the premium. Okay, so whenever yields move, the price of the bond will keep moving in this band. Okay, now this is actually, while it may look like a straight line from a distance, but it is actually not a straight line, because price and yield are inversely. So it is in a convex. Okay, it is not a straight line, it is convex. And there is a very important concept in the world of bond mathematics called the concept of convexity. Okay, which we will learn later. Okay, if you would like to do some research about this word convexity, then you can do that, but we would definitely come up with a series of videos on about this concept of convexity, which is one step beyond duration. Okay, so duration says that if the prices change, what is the change? So if yields move from 9 to 10 or 10 to 9, what is the difference in price that I get? So this is the delta. And then the second, but if there are bonds of various kinds of convexity, you can get higher amounts of price movements depending upon which direction the convexity is. All right, so all the best, everybody. I hope you guys are truly enjoying. These videos can become really sophisticated with passage of time, but it's for those who want to go really deep into the world of fixed income and understand how this bond mathematics works. All the best, and we'll speak to you soon once again.